Poor economic data out of China, unrest in North Africa and the Middle East, rising oil price, European sovereign debt problems. We have rising risks at this moment. What do investors do at a time like this, Peter?
There's certainly been a lot of bad news, and I mean, this morning we've got the earthquake in Japan, their market's down off the back of that, and obviously it's a tragedy for those people. But generally, when we look at events like that, so for instance Japan, or even Libya, Egypt, any of those, they tend to be reasonably small in the greater scale of markets. And very often when you have something bad happen, there will be a policy response whereby there's increased spending and markets tend to recover fairly quickly. So as a general rule, we wouldn't say something like the Japan earthquake is material to markets. However, as you highlight, we've had a number of these events coming through sort of week after week. And I think it becomes harder and harder for markets to move forward in that environment because your balance of risks is deteriorating insofar as the growth outlook, etc., is deteriorating. I think the one thing that probably worries me the most is actually the ECB signaling that they are looking to hike rates more aggressively than the market expected, and we've certainly seen forward rate expectations there shift up. Personally, I think that may be a bit premature considering the concerns in Greece. I mean, Greek bonds are still trading at over 12%, so it's not as if they're out of the woods yet. So I think rather than looking at the short-term sort of news flow events, which aren't a concern, the rising inflation, the rising rates as the back of that is negative in the longer term in terms of taking liquidity out of the marketplace.
Some of these short-term events, as you mentioned, we have the problems in the North Africa and the Middle East at this stage. They do have a longer-term impact, so and we don't know how much longer-term because we don't know how long the oil price is going to stay at $115 and above, Peter. So how do you build that into your strategic thinking going forward when you're building a portfolio?
You're absolutely right. We've got no idea what will happen in terms of Egypt, Libya, etc. I think what you have to look at is the real price of oil and what is sustainable. In the medium term, we would have expected oil to go up. It is a shrinking asset and there's growing demand from China, from emerging markets. You just need to look at car sales and it's pretty clear that more fuel is going to be consumed. But having said that, in the shorter term, I think it's probably priced in too much. So in a balanced portfolio, as an example, we had a large holding in Sasol. That made sense to us in terms of Sasol's fundamentals as a company, our expectation that the oil price would rise over time, and the expectation that the rand is too strong and was likely to weaken. So you can't build a portfolio based off one forecast or one expectation of what's going to happen with a political event because we've got no idea on that. What you need to look at is a bucket of ideas and do they correspond? So does the theme and the valuation coincide? And if they do, then it makes sense to put it in a portfolio.
So what does your bucket of ideas tell you at the moment then, Peter? If you are going to look past some of the short-term noise, what are the fundamentals telling you going beyond that?
Well, I think what we're seeing in terms of earnings coming through are dropping multiples. As markets fall, you start to get value coming back onto the table. So at the beginning of the year, what we said in terms of a roadmap was that returns would be fairly subdued, would be worse than last year because last year was exceptional returns. And with rising inflation, rising rates, we expected some headwinds to that. Having said that, we would have expected equities to outperform other asset classes. So I don't think I would change that longer term view. What we see here is more of a tactical issue in terms of some potential weakness, and if that weakness comes through too fast and too quickly, it'll give an opportunity to buy back.
You talked about earnings season. Just following that earnings season and also the small pullback we've seen in our markets here in South Africa, are you starting to see more realistic valuations in the South African market and perhaps more value?
Not that much. The reality is, so if you look at March's earnings so far compared to a year ago, they're 36% up. So obviously that drops your historic PE, and the historic PE's dropped down to around 14 times from over 17 times. But no one would be using that historic multiple in terms of their thinking. We would be using a forward multiple with those earnings expectations already priced in. Having said that, if we look at the market at the moment, it's on about 12 times forward. That's still not offering mouth-watering value, but it's reasonable relative to the real return that we would expect on cash, which we don't expect to be great, and bonds at the moment are actually looking a little bit better than they were because obviously bond yields have kicked up. So we would expect a better return from bonds going forward than we did at the beginning of this year. So if we look at that 12 times multiple and you take it, there'll be 60 odd stocks out of our universe of 120 large to mid-cap size companies that are trading on multiples of 11 times, forward multiples of 11 times or less, and those offer value essentially. So I wouldn't say that the whole market is offering value, but there's certainly individual companies that are starting to offer better value.
Well, Peter, last time we spoke, we discussed the merits of global diversification. Given the rand's strength that we have seen over the past few weeks and the attractive relative values offshore, do you think that that still holds true, or do you think that with some of the risks and the uncertainty we're seeing at the moment, investors should think twice about taking cash offshore?
No, I still think it makes absolute sense. As I said last time, you've got to look at it on three different levels. What makes sense to the portfolio in terms of a risk-return structure, and generally having around 30% plus makes sense. So where we sit in most balanced funds is we've been allowed to go up to 25%. So if you're sitting below that and the rand is stronger, that gives you an opportunity to increase offshore. So the one thing is that logic. The second is the relative value, and the relative value is still intact. And the third is the real value of the rand, and that still looks reasonably strong in my opinion. So there's the potential for rand weakness to come through. What has been very interesting, of course, is as we've had a little bit of risk appetite decreasing or risk in the world increasing, the rand hasn't actually weakened, which shows that the rest of the world is not as worried about the currency as it used to be. Traditionally, when there was a bit of a wobble, the rand would weaken. That certainly hasn't been the case this time around.
Peter, you mentioned the threat of an ECB rate hike. If the ECB does go ahead next month and raise interest rates, what are the implications of that for the equity markets in Europe specifically?
Okay, if you look at the European markets, they're typically trading on less than 11 times forward. I don't think that they are, and the relative return on cash is still very low. I don't see it as a massive train smash for the valuations of the markets. Clearly, it puts additional pressure on the periphery where I think there are still funding concerns. So it'll probably be a mixed effect. You've got the strong core, which is doing well, and you've got the weaker periphery, which I think will battle with higher interest rates.
Peter, have you ever given any thought to what happens when QE2 runs out at the end of June, and whether we could have more quantitative easing coming out of the United States, which would perhaps boost markets? But if we don't have any more quantitative easing, who's going to step in and start buying those treasuries? Because the Fed has been buying up to 70% of all issuance, hasn't it?
I think in terms of QE2 or moving on to QE3, it's going to be data dependent. Generally, the macro data around the world has been coming through much stronger, and that's certainly been the case in the US. As that comes through, the need for continued stimulus decreases. What we're unsure about is if the oil price is still high, that's a deflationary shock. The earthquake in Japan, is that going to drop growth? So I think the Fed will assess it at that time. But considering the underlying macro is reasonably robust in America, it's unlikely that it will be extended. If you look at US bonds, clearly bond yields have gone up from where they were at their lows, and the yield uplift relative to cash is still quite high. So for US investors, there could be some value there, but longer term, we don't see value in that. We see a risk in terms of funding that, and as a result, we don't own any offshore government bonds in our portfolios.